This is Scott Becker with the Becker Business Minute and the Becker Private Equity Business Podcast. Today's discussion is the inverted yield curve and what it means. So one of the things people talk about in the general parlance of finance is an inverted yield curve. An inverted yield curve essentially means that the 10-year Treasury yield, the 30-year Treasury yield is lower than the short-term Treasury yield. So in most of my life as an investor, yields on bonds, Treasury yields, are usually higher the longer out they are. So people pay you more money to hold your money with them for longer. So typically a 30-year mortgage would have a higher interest rate than a 15-year mortgage. The 15-year would have a higher interest rate than a 7-year. A 10-year Treasury might be 4.5%, a 1-year might be 4%. That's the typical sort of situation. Periodically, there's what's called an inverted yield curve, and that's what we're seeing now. An inverted yield curve means that, for example, the 10-year Treasury yield is about 3.7%, but the 1-year Treasury yield is about 5%. So people are paying a much higher interest rate. You're getting a much higher interest rate on your money in the short term. If you invest in Treasuries, you're getting 5%, than if you locked in a 10-year return. If you lock in a 10-year return, you're getting 3.7%. If you have a 1-year return, you're getting 5%. And what that means to analysts, investors, Wall Street, and so forth, is that over time, the perception is the economy will go in the wrong direction, and the Fed will have to lower rates, not raise rates. Thus, you have this inversion in the yield curve, which means over the long run, the expectation is that the Fed that has hiked up rates so much in the last couple of years to fight inflation will find itself within a few years having to bring rates down to loosen money lending into the economy. Thus, you have what's called the inverted yield curve. It's essentially a bet that sooner or later, the Fed will have to reduce rates, and that sooner or later, the economy will go in the wrong direction, causing the Fed to reduce rates. That's what the inverted yield curve is expected to mean. Thank you for listening to the Becker Business Minute, the Becker Private Equity and Business Podcast.